Welcome to TheoTrade. This is Don Kaufman. It's July 16th, 2018. You are watching the Theo Night video. Well, allow the games to begin. It's earnings season, people. And that's precisely what we're going to talk about this evening on the video in what has and can only be described as an incredibly dull market today. For those of you interested, the S&P futures, they didn't even trade 700,000 contracts, and we're just about at the closing bell. That is almost record-breaking low volume. Again, for those of you that do tune in on a day-to-day basis, take a look back over the last 9 months. People, you got to go all the way back to right around the Christmas holiday and even a half a trading session to see volume as low as we're currently seeing. With that, as I said, let the games begin, as Netflix is reporting in just mere moments. Literally, we're going to see Netflix report as I actually come into this, and we're going to discuss a little bit about, there's the closing bell. We're going to discuss a little bit about earnings and earning style trades. With that, I actually created an entire grouping of trades specifically surrounding earnings. Now, whether you're into earnings trades or not, it's incredibly important to have a detailed understanding, okay, of what really goes on specifically around option trades related to the earnings announcement. And even though, and I recognize, even though, Netflix, well, they're about to report right this second. Okay. With that, they have a $33 expected move. And I recognize that the trades you're about to see, by the time you see this, will already have kind of come to fruition or, okay, died pretty much, outright. Nevertheless, these style, okay, of trades can be used moving forward. All right. And any of the major products, whether it's going to be Amazon, whether it's going to be Google, or again, we're looking at Netflix right here, whether it's Apple, any of the major tech companies, or really anything around earnings is going to be very, very similar in fashion. So let's get right down to it. Whenever we discuss earnings, one of the most important things I think to kind of distinguish specifically about earnings and earnings related trades is that what can you do around earnings? And it's a fair question. What can you do? You can get what? You can get bullish, you can get bearish, or you could actually get neutral. Now, there's going to be what we call kind of neutral long, and there's going to be what we call neutral short. Now, what I'm going to do, again, in this evening's video, is I'm just going to take you through a couple of very, very brief ideas, a few brief trades, kind of recapping a little bit of what I did in the TheoTrade chat room earlier today to kind of get you up to speed, because there's all this discussion about, this is an edge in earnings and this is not an edge in earnings and this trade works out great. And when it comes right down to it, come on, people, you can get bullish, you can get bearish, you can get neutral long or neutral short, and that is it. You can't get anything other, okay, than those four plays on earnings. Let's start with what is a bullish trade. Now, this bullish trade is what we call an in-out spread, and it's a pure binary play. For those of you who never heard that terminology, the binary play, I mean, for the most part, that means heads, you're a winner, tails, you're a loser. It's a binary trade. You're going out, and we're actually purchasing a call spread. It's a 395. Okay, we're purchasing the 395, selling the 397.50s. We're doing the entire trade, which is a $2.50 wide spread. We're doing it for about $1.25 debit. So what are you doing? You're really risking $1.25 to be able to make $1.25. That's it. It's a bullish trade. How do you decipher being bullish? Come on, you got to realize by now earnings are a bit of a coin flip. So flip the coin. Heads, you're bullish. Tails, you're bearish. Now, the opposite is also true if you wanted to create a bearish trade. And I'm literally right now, okay, I'm trying to give you perspective on all of the different styles of trades. Now, as we start to mature through earnings and through the earnings season, I will distinguish and I will take sides and I will actually show you, okay, specifically and explicitly what we're going to do around earnings, where I think that there might be a couple of edges here and there. But right now, it's important to just get the logic behind us of what we can even do in earnings. So this happens to be your bearish trade. Now, the bearish trade, people, it's just the exact opposite of the call spread. So I did the call spread, right? Now I could just look at the put spread, and the put spread is $1.25. So once again, it's a binary trade. Here, this one again, when I say a binary trade, heads would be, oh, you're bearish, tails this time would be, you're bullish. the put spread, again, another binary position, is your bearish trade. All we're trying to do is go out there and not lose, a couple of fingers or an arm. Essentially what I'm saying is you don't want to have, this monstrosity of risk hung out around us. Now, let's move on. Now let's talk a little bit about the Iron Condor. Now the Iron Condor, this is what we'll call the neutral short position. Again, why did I call it neutral? Why do I call it short? The neutral short position in this particular circumstance. So first of all, when I say short, I'm not pertaining to that I'm short the marketplace. It's neutral short, meaning that I'm actually selling options premium, and I hope that we stay in a definitive range. So if Netflix closed right at the 400 level, which it effectively did, all I'm trying to do is peg Netflix within a given range. Now for that, I'm collecting about $1.50 credit. Now this is a $5 wide call spread and a $5 wide put spread. What can you lose? Well, you could lose $5 up here, or you could lose $5 down there. But on expiration, the stock can only be higher or lower. So what's your total risk? $5, of which you collected what? $1.50 up front. So definitive out-of-pocket risk is $3.50. For those of you, if you're kind of interested in a little bit of like geekism, like options geekism, kind of figure out what the probability is effectively in that particular position. And of course, we've got Netflix that's reporting right now, so we'll take a look at it here in just a moment. But what you want to do, figure out probability, take $3.50, which is your risk, divided by the width of one of the spreads, which is $5. That trade effectively has a 70% probability of making 1 penny or more. By the way, let's go back to the trade tab for just a second, because Netflix is out after the bell. And the interesting irony, how far has Netflix moved? Now, this is something that we're going to get into here just in a moment, but Netflix was at 400. It's now trading where? Well, about the expected move lower. Do I need to even mention what the expected? It's $33. Look where Netflix happens to be. It literally moved right to the edge of what was expected. Now, it doesn't mean it's going to stay there. It does not mean that. Nevertheless, the efficiency of what's termed expected move in the front expiration cycle is absolutely uncanny. And I talk about this ad nauseum with the SPX, but it's also relative when it comes to earnings and earnings related trades. So we've gone through 3 trades now, right? There's a bullish trade. Clearly, we see the bullish trade's not going to work out. There's a bearish trade. Yeah, the bearish trade would be an absolute home run. Then we come to the Iron Condor. Now, the Iron Condor that I created, the bottom strikes are 355, 350. Now, I created these, again, before the market closed today, and I'm recording this as the earnings are coming out. Why? Because you can learn on the fly over here. And you can see that, Netflix is coming close to the downside of this 355 strike, but I'm just outside the expected move. Now, I come into something what would be called a neutral long strategy. This one is, I'm just buying. It's just the opposing. Instead of selling the Iron Condor, I'm literally buying the Iron Condor. And quite frankly, given the fact that Netflix now has moved over $40, which is exceeding the expected move, things are getting dangerous in there, and maybe buying an Iron Condor might be the place to be. Last but not least, for those of you that like a little complexity in your life, well, then we come to what is a double calendar. Again, a double calendar. And the complexity of the double calendar, all right, is many, many fold in here. But the double calendar happens to be a 360 calendar and a 427.50 call calendar placed simultaneously. Again, all of which can be placed in and around the earnings. Now, what you're going to see in the days, and the weeks to follow is me constructing, all right, some of these positions around earnings. Then, and only after understanding the trades and really the logic behind this, then I think it's okay to go out and fire off a couple of positions around earnings. With that, Netflix is out, and it is not pretty after the bell. We're now down, $50 after the bell. With that is dragging the Nasdaq futures down solidly. So we have a day with absolutely nothing that occurs. Get this. One tech company releases earnings. It is a mild market cap in comparison to something like a Microsoft or an Apple or, God forbid, an Amazon. It's a mild market cap inside of Netflix, but it actually doubles the move down inside of the S&Ps and crushes the Nasdaq heart and soul in a matter of a few seconds. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.